Welcome to Bar Charts Market on Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. Global bond yields rise in the face of expected rate cuts. What's the lesson or warning? Gold shines again, and Goldman Sachs predicts $5,000 by the end of next year. Is this a possibility of reality or more rational exuberance? We're going to talk about the power of gaps and what Google's price action is telling us. And I want to share with you an unusual options volume and unusual options activity in the Brazilian ETF. And why this is more than unusual, but it could be something that is extraordinary. All this plus your questions, and to help me out is my co-host, our Mr. X, Twitter Tom. Hello, Thomas. Did I lose you already?
Hello, John. How's it going?
There you are.
Hopefully not. You got me?
I hear you now. I do hear you. Yes, sir.
All right. Just so everybody knows, my internet's a bit spotty, guys. So if I drop off, just hang with John. He'll take you through the show. All right, John. We got a jam-packed show, so let's jump right in. Global bond yields, John. The story that just will never die. We hotly debated this, whether we should keep doing this. I'm a bit bored with bond yields. You keep saying, hey, this is an important story that we have to cover. UK. So the UK, John, the United Kingdom 30-year gilt just hit 5.6% last week. That's the highest level since 1998. Japan 30-year yield just hit 3.3%. In fact, if you guys follow us on X, I'm covering these yields all the time. This yield, John, it's almost like automatic. You just look at it every single day and you find it higher than the day before, highest level in history. So, John, what is the backdrop here for global bond yields, and what is the connection to the average trader and investor? Tell us why they should care.
Yeah, I think this is a bit of a warning and also a lesson to the Fed, particularly that, cutting short-term rates doesn't necessarily mean that, all interest rates are going to fall. And long-term rates do have a more impactful bearance on consumer debt, corporate debt, and governing borrowing costs. So the conditions in the UK are very similar to what is going on, according to the Fed, in the US, slowing growth and sticky inflation. And the BOE and the European Central Bank have been cutting short-term rates, and yet we're seeing G7 long-term bond rates go up. We're seeing them going not only in England, you mentioned Japan, but France, Spain, Italy, all of them. So what does this really mean to us? And I think what it is, it comes down to supply and demand. So first of all, let's talk about supply, right? Increased deficit spending. A lot of these European countries are now being required to spend a lot more towards defense. That borrowing means that they're going to issue more debt. And that is increasing the supply. If we think about short-term rates, right? Cutting short-term rates does not necessarily mean that rates are going to come down. It actually might put pressure on, or at least increase the exposure to the long end of the rate curve. So that is the bit of the supply side. On the demand side, what we're seeing is that, I think you had a tweet a couple of weeks ago or a week ago where you said that we are in like a 60-month drawdown of government issuances, right? In other words, folks are not buying government debt, not necessarily U.S. debt, but debt in general. That has been happening.
Yeah, that was a 61-month drawdown by far, John, by far the longest drawdown in history.
Well, so what does that tell us? Is there's a reluctance to buying G7 debt. Again, that's the demand side, right? So more supply, less demand. That means that prices have to go up. excuse me, prices have to come down, yields have to go up to make it more attractive for somebody to take on that debt. So I think this is an important story for us because if we look at the U.S. debt and look at the U.S. bond market, 30-year bond market, we are at a very critical level, right? And so in the next couple of weeks, we're gonna find out what the Fed's going to do. They're probably going to cut rates. It's basically 100% guarantee right now. So let's see what the bond vigilantes say to us, right? After they cut short-term rates. If we see the 30-year note pop back above 5%, let's say it gets up to 5.25%, and I think it might even run up to 5.5%. This is a headwind for the equities markets because higher, longer-term rates discount growth, and that is a negative or negative for equity markets. So again, I'm not, saying the world's coming to an end or the sky is falling. All I'm saying, I think this is something we need to be watching. We need to watch carefully because if the Fed starts cutting rates and the long end starts going up, this is going to be a very difficult environment for the equities market. And that's why I want to kind of put this on our radar over the next couple of weeks.
All right, John. So let's jump to an asset that is very closely connected to the yield story, and that, of course, is gold. Now, John, I'm personally a little bit upset because I was hoping gold would have this little bit of a pullback, maybe get back to 3,000, maybe a little bit under, and I could sort of increase my position. We've talked about this on past shows. I felt like I didn't have enough gold. Well, I guess I'm not going to have enough gold for quite a while, John, because gold just keeps going up and up and up. Recently hit a new all-time high. In fact, I think it's been hitting multiple new all-time highs in the last few days. But there's an interesting story, John, which really caught my attention. And that is a forecast from Goldman Sachs. They predict that if the Federal Reserve loses its independence, gold could hit 5,000 by the end of next year. Obviously, the Fed independence, John, it's a big story right now with interest rates and politicians and all of this. What do you make of this story, John? And do you think 5,000 is that just a throwaway number from Goldman Sachs, or do you think there's a legit possibility that 5,000 could be in the cards?
I think the independence story for the Fed is definitely legitimizes the potential for this happening. Again, if the Fed is now more accommodating and cutting short-term rates, that is more that inflationary story, that expectation. And I think that we can think about this in terms of gold right now. That is probably what is driving the gold market. But I think it's also, not only the concerns of the independence, but also there's this kind of dynamic that is happening in the gold world. In other words, as gold is more of a safe haven asset, there is this dynamic that traditional safe haven assets are being overlooked. In other words, are being bypassed. Again, think about the reluctance of individuals or institutions to buy government debt. And so I think if we look at gold, what's going on in gold right now, and I'm going to pull my chart here. This explosive movement to me, normally I would say this might be a dollar story, right? A weakness in the dollar. But really, I think what is happening here is that, dollar receipts, in other words, when we buy goods and services around the world, those dollars used to come back to us in treasuries. We used to call that petrodollars. But we're not seeing that. What we're seeing is that a lot of central banks are taking US dollars and buying gold. So now what happens is gold really becomes more of a real relationship, a ratio between what the dollar is worth versus what gold might be worth. And that, I think, is exactly what is happening in the market right now. So where can we go? Can we see 5,000 in the Goldman Sachs story? Now, I read the article, and now here's a couple facts for you. And this is kind of their base for them. They looked at central bank global reserves, right? And right now, global reserves and central banks are for gold, they're at 27%. And that is at a 30-year high. This is, this is kind of reflective of what we just said in our opening segment. And US Treasury reserves are at 23%, which is the lowest since the GFC. So this is reinforcing that idea that dollars are not being spent on treasuries, they're being spent on hard assets. Not only gold, but you can look at platinum and silver. I think silver just made a new 40-year high or something just recently. So we're talking about hard assets here. So let's look at the dollar here, and this could give us a little bit of a direction here. So here's the dollar index, and again, we just look at gold prices have rallied, pretty explosively in the last few days. But the dollar has kind of just been in a range, right? This is why I really think that this is not an inflation story right now. I think this is going to be more of this conversion of the dollar as a reserve asset away from that, and that the safe haven that gold provides is going to be beneficial of it. Now, if we look at what the dollar has done since the beginning of the year, it's about, I think it's down about 12%, since the beginning of the year. And gold, if we look at what gold prices have been doing since the beginning of the year, let's go to a weekly chart here. I think gold prices are up about 40% on the year. So again, if we do this 35%, so we do this math and we go back to the dollar index and we look at this in a bigger picture. If we break out of this channel, this weakness in the dollar, which we're anticipating, well, how far could dollar fall? Well, I think it could fall down to like around the dollar index, somewhere around 94, 93 and a quarter. That's about a 5% from where we are now. And if the dollar fell 11% or 12% during this year, and another 5% based on what gold did, which is about 35 to 40%, then I think we could extrapolate that gold prices could go up something like 16 to 17% from current levels. So let's say the gold is trading around $3,600. Then that would make, a value somewhere around $4,200. That would be relevant to, let's say, if the dollar fell down to about 93 or 94-ish range. So I think that is more realistic. But what Goldman Sachs is saying, that the gold ETF market is only 1% of the treasury market, and just a 1% shift of monies out of U.S. treasuries into the gold ETF would then translate into $5,000. So I think out of the realm of reality, probably not something that could happen, but is definitely possible could happen. In the short term, though, Thomas, I'm kind of thinking that, I was looking at the GLD, right? And let's look at this from a technical aspect here now. One of the things we can do is we can look at, previous levels of consolidation. We're kind of range bound. And when you break out of one of these consolidation ranges, what you can do is you can extrapolate the range and you can add it or subtract it, depending if you go up or down. And that could give you a first objective target. And you can see that this has happened in gold multiple times, where it goes into this consolidation pattern and then it breaks out. And you usually get this impulse move, and then you get another little bit of smaller pause, and then you get another impulse. So does seem like there's a lot of room for gold to run, because certainly we are in, the neither world or nether world in terms of no resistance, right? We're at all-time highs. So yeah, I think we could see higher prices, but in the short run, I think we're probably gotten a little bit ahead of ourselves. If I look at this from an RSI standpoint, we see that RSI can stay overbought for long periods of time. We're in an overbought condition right now. If we look at this from the lens of our Bollinger Bands, right? Again, let's make this a little bit easier to see. We are well outside of the Bollinger Bands. But again, what is price still doing? It's still rallying up. We're not getting that reversion, right? But we are getting close to that first objective, that first target based on that extrapolation. So again, I think the reality is that gold is going higher. Where could it be a week from today? Maybe a couple of percentage points higher than here. Where could it be by the end of the year? I think there's a psychological number of around 4,000. Where could it be by the end of next year? Well, then I think that really comes down to is what happens with the dollar. Is the dollar going to lose its status? And are we going to see this continuance of what is happening with interest rates? Now, the caveat to the whole thing here is that at some point, long end interest rates will be a headwind to gold, because that safe haven aspect will compete with gold. In other words, safe haven of longer term treasuries or longer term bonds. So I don't know. I guess for you, it feels like you probably missed the boat. But what I'm saying to you is, this just gives you confidence just to go out there and add it to your position.
Yeah, and John, to Goldman's point, I saw this visual, which I thought was pretty fascinating, which is foreign central banks now own more gold than U.S. treasuries for the first time in 30 years. So that's kind of what you mentioned, John, and what Goldman mentioned in the article, is that if we start to see a rotation of capital out of the treasuries into the gold market because of various reasons, but primarily, perhaps a loss of confidence in the Fed, then you could start to see that upward momentum, maybe towards that $4,500 to $5,000 range.
Yeah, I mean, I don't put it out of the realm of reality. I think it's a huge number to try to get. I don't know what kind of financial world we will be in if we do see $5,000 gold. That might be another story for another time.
Agreed. Yeah, I don't think it's something that people who own gold will be happy, I guess. But then, what are the consequences of that?
Exactly.
What else?
That's kind of my point.
Where else are they going to be hurting? All right. Well, let's move from gold to a more enthusiastic, promising, hopeful story, John, and that, of course, is Google. Now, we've covered Google, John, very recently. Both of us have been bullish on gold. We talked about the possibility of a breakup and what that might mean for the value of the company. But even without that, John, I think we're both still pretty bullish on Google. It's a good business. It's not going anywhere. Some people say ChatGPT is going to kill Google. No, it's not. But here's why we're covering it this week, John. Google just scored a major legal victory. A judge ruled that they will not have to divest their Chrome browser or their Android business. So there was a lot of rumors that Google might have to sell one or both of those. They will not have to do that. Google's price just hit a new all-time high. In fact, it's hit new all-time highs in 3 consecutive days, John, and that's coming after a big gap up. So, John, you're the charting expert. You're the TA expert. What does this price action look like to you?
Yeah, so gaps to me represent the largest imbalance between buyers and sellers. And, I respect gaps because I think they tell us a very unique story. Now, the gap itself is not necessarily as important to me as what happens after the gap. In other words, do we see a follow through? Now, initially, when I heard about this gap or this rise in price based on this news story, I was saying to myself, well, did something fundamentally change? Because usually that's what is the driver, the catalyst, some kind of fundamental news. Now, did anything really happen or change in Google's business model or how they conduct business? No, I think all it did was, and I think to your point in our production meeting was, it just cleared the air of uncertainty around Google. But what the evidence is telling us here is that there was probably a lot of pent up demand. The folks who wanted to buy Google but were afraid to because of this pending court case. And so, what the gap here is telling us is not only the gap, but the follow through here is that folks are willing to pay more for the same asset that they could have bought 2 weeks ago or 3 weeks ago. Why? Because they have clarity. They believe that now there's room for Google to run. Now, gaps themselves, in terms of, there's different types of gaps, and there's actually a cycle of gaps. There are what it's called breakaway gaps, there's continuation or runaway gaps, and then eventually you have what is called an exhaustion gap. Now, if you look at the price here of Google, we see this large rally, and before we got this gap. So I don't know if this is necessarily would be a breakaway gap, but I think your argument might be that, yeah, we did break out. We broke out from an all-time high that was back in February, right, Dallas?
Yeah, my point, John, would be Google has underperformed for a long time because of that cloud of uncertainty on the legal side of things. And now that it finally broke that high, I think you might start to see that momentum continue because it sort of has to catch up to these other high-flying Mag 7 names, right, that it's been underperforming all year. And in fact, in a prior show, John, we called Google the value play out of the Mag 7 group of stocks. Well, now it's got a chance to show its true value, right?
Yeah, I think this makes a valid point. Again, we've also talked about rotation inside of that space. That's those 5 or 6 stocks, right? The NVIDIA, Microsoft, Meta have been dragging the market higher. Now what we're seeing is that money, the profit taking is coming out of there. Now it's going into Google now because of that clarity. So, it could be a breakaway gap, and that would be very positive for Google to continue to run if that was the case. And if you look at previous runs in Google, let me change this to a weekly chart. You can see that going back to 2020, we had a 200% run. We had a 130% run. Now, both of these runs on a weekly basis were around 80 weeks. We are only 17 weeks into about a 60% run. Now, I'm not predicting that this is where we're going to get a 200% run or a 130% run, but it certainly says history tells us there's a lot more room for Google to run, and we're only in the beginnings of what looks like a beginning of a big movement in Google. Now, the other gap would be the runaway gap, or that continuation gap. So again, we could look at for just short-term projection, we could look at the length of this gap, wait for our price action, and then we can extrapolate where the next leg or next run up. What concerns me more is that this is a very dense market, right? A large market cap, right? And a 10% run in a market like this, that is kind of concerning for me, right? I mean, I would expect this from a biotech or from one of these, these quantum stocks, not from a stable stock like this. I would expect, like 2 or 3% run, or multiple day runs, not a big 10% run. But the evidence here on the gap is telling us that there is something going on here, and that sellers are not willing to sell and buyers are willing to pay a higher price. What would be the concern? If we fall below the gap, into the gap, and that might tell us that we might get a reversion or we might have an exhaustion gap. But I don't see that happening right now. I feel like I think you make the call on this one. This is money coming out of NVIDIA, Microsoft, and Meta and going into this value play that has now clarity that the market is going to go higher.
John, you mentioned Google sellers not selling. I'm one of them. I own Google, and I'm not selling, and I have no intention of selling anytime soon. Maybe if we get one of those 130% to 200% runs, John, maybe then. All right. So, John, the next subject is all you. You kind of brought attention to this, which is in regards to Brazil. So you noticed that in the Brazilian ETF EWZ, there was some massively bullish options activity. John, you caught that. Tell us what you saw. Tell us what you think it means. And did you dabble in that market? Did you add any of those contracts to your own trading style?
All the above, my friend. All the above. All right. Okay, so this is a screenshot from the put call ratio on the EWZ on August 28th. And what I noticed was it actually came up on an unusual options activity and also came up on unusual options volume. And what I noticed was there was a huge amount of options activity in this particular ETF that was not only across multiple expirations, but multiple strikes. Now, let's get it back up. August 28th was the Thursday before Labor Day weekend. And if you recall what happened over Labor Day weekend is we got a court ruling, another court ruling, that the tariffs were illegal. And Brazil has been one of the countries that has gotten some pretty punitive tariffs, I think like 50%. So I don't know if this was a trader or an institution that had gotten wind that this court ruling was going to come down. But what it does tell me is that there is somebody or an organization or institution that is very, very bullish on the EWZ. Now let's go inside of the EWZ and look at some of these what happened in these strikes. Okay, so here is the put call ratio, and I really like this as my jumping off point to when I see like unusual action, because I really want to see if it's all in one strike or one expiration, or if it could be carrying over. Now, what we can see here is this is today's. Now, this has been actually carrying through for all of this week. I noticed it every day this week. There's been a lot more call action than there has been put action. And you can even see today on the October, you got almost 6,000 calls versus 1,000 puts. You got the December option expiration, 5,000 calls versus literally no puts. A little bit more even here, maybe 2-1, 2.5-1 in the March. Here we see June, right? So let's go first to this March 2026. And I'm going to open that up, and we're going to see that this is really that activity. Look at all this call open interest that happened. Now, again, look at today. There looks like maybe of some kind of vertical call spread that was being executed today. But looks like it's probably buying the 32 call versus the 35 call. But here's the $37 call. And if I open that up, and I want to go into history on this one. There it is. There is that 50,000 volume that happened on the 28th that has now been converted into open interest. In other words, they're committed to that market. Now, this one trade, that was about a $1.5 million trade. Now, I'm going to come back to this in a second, but I want to show you another trade in the put call ratio. And this was a leap. This is the December 26 calls. And I need to widen the field here. Let's look at all of them, not at the monies. Here's the $45 call and 63,000 open interest. Again, let's go to the volume on this one, or the history on this one. Again, there it is, right? Volume commitment to the market. So let's go back to that March strike, and what I want to go back to our expected moves. And if we look at the March expected move for the EWZ, right? Saying that between now and then, there could be a 13% movement in the EWZ, and the upper end of that would be $33. Now, if you recall, that trade was $37. So this person has a huge amount of confidence that we're going to see a big move in the EWZ between now and March. Matter of fact, almost what? 10%, 15% above the expected move. And if we look at, let's say, the expected move of the December, the leap, $37. And that was a $45 call. And this was not just in these two strikes. This was in multiple strikes over multiple expirations. So I don't know what's going on here, Thomas. But, if you think about this, and if it is related to the tariffs, but what if it's not related to the tariffs? What if it's somebody who says, okay, well, I have a customer and I'm going to spend a lot of money, or I'm going to start buying a lot of their goods and services. And I want to take advantage because I know that my business is going to drive their stock price, so to speak. Well, who is Brazil's largest customer? It's probably not the U.S. I bet you it's China. And I'm wondering here if this is China's recognition that Brazil is going to do very well by itself without even the U.S. markets. So I'm very bullish on this one. So I actually followed this trade. I did the December 25s. It was the 31 calls. I don't think I paid more than $1 for those. Again, the expected move for that is $34. So hopefully I will be right on that one.
Definitely a good story to keep tabs on over the future, John. I'm sure we're going to talk about it again.
It is definitely an extraordinary amount of monies that this was. We're talking about close to maybe $100 million are spent in options in all on all.
All right. So, John, we were going to initially talk about the Kraft Heinz situation. For those of you following the news, Warren Buffett came out and publicly said that it was one of his biggest regrets in his entire professional investing career. That's really saying something. But, John, there was another story that came across the news this morning, which I thought was really interesting. And it involves Tesla and Elon Musk. The Tesla board is proposing to pay Elon Musk up to, hold on to your chairs, guys, hold on to your chairs, up to $1 trillion in compensation. Now, John, that is contingent upon a couple of things. First of all, it's going to vest over a period of 10 years. And in order to earn that, John, Elon has to get Tesla to an $8.5 trillion market cap. Guys, that is double what NVIDIA is right now, and NVIDIA is the world's most valuable company. So, John,
go ahead. I'm sorry.
Yeah, John, is $8.5 trillion. Is that even possible for Tesla? And do you think is this a bullish thing for Tesla shareholders, or would you be upset if you were a Tesla shareholder?
I think before, when it was a reality, when the last time we had the compensation issues, I thought that would be, as a shareholder, I might be a little upset. But in this one, I think you got to take this as bullish, and you got to be a positive to it. I was just curious, did you do the math? What does an $8.5 trillion Tesla stock price look like? Did you happen to do that or not?
I think Tesla's about $1 trillion right now, and it's at 350. So multiply that by 8. I think you're looking at $2,800.
$2,400 or something?
I think it's like $2,800, John.
Oh my God.
So I kind of want to run out. I feel like, I try to get rid of my gambling tendencies, John, in the past, and I've done pretty good at that. But this kind of makes me want to run out and start buying up Tesla shares because I'm with you. I see this as a really bullish story for the company, and it's going to motivate Elon, and I think it's going to be good in the end.
It's just unfathomable about, if you're talking about $28 trillion, I mean, that's probably more than the economies of the whole G20, right? Not the G7, but the G20. I don't know. Just seems.
I'm really curious to hear from our viewers, John. I want all you guys who are watching right now, I want you to leave a comment. tell us, is Elon Musk worth $1 trillion? I'm really curious to hear what people think about that, John.
If he can get the stock price to $8 trillion, why not? Right?
I might as well, right?
I mean,
What's one? If you get eight and a half trillion, what's a trillion at that point, right?
exactly right. But then again, you got to think about how does Tesla get there, and what are they selling? Is there technologies that we haven't even fathomed, or is it going to be like, your house is going to be full of, instead of Roombas, they're going to be all these little Tesla robots, right? Or, you don't own a car, you just walk outside and you hail a Tesla taxi cab or whatever. It's you're basically saying that Tesla is going to be a huge part of every person on the planet Earth's life, right?
Well, the good news for us, John, is this is going to be a continuing story for at least the next 10 years. So we will be able to talk about it multiple times over the course of that period.
Yeah,
All
I
right.
have a feeling that the story has more legs than maybe you went on.
All right.
All right, we're a little over today. What do we got? I know we got a couple questions, right?
We do. We've got quite a few, and I've already seen the first comment. No, Elon is not worth $1 trillion. Thank you for that contribution. All right, John. The first question is in relation to biotech and biopharma and pharma stocks, however you want to categorize them. The question is, do these stocks, can you analyze them on charts? Do chart patterns and technical indicators play any role whatsoever in the movement of these biopharma and pharma and biotech stocks, John? Do you want me to lead off with what I think?
Yeah, I think you had an interesting take. I thought the question was a little slanted, or I don't know what was the objective of the question, but I think you have an interesting take on this. So I want to hear your take on this.
Yeah, I mean, my take is I have always, this is a sector that is unique unto itself, and I've always felt that it's completely news driven and event driven. You have people who get paid a lot of money to analyze these events like PDUFA dates, John, and FDA approvals. They really get into the weeds on all this stuff. And I've always felt like those are the drivers of price action, not looking at whether these stocks are trading above or below the 20-day or the 200-day, or that they form a head and shoulders. I don't think that stuff matters for these names. However, leading into these major events, you can look at charts. You can look for clues. Have people gotten a whiff of what is coming down the pipe over the next week or couple of weeks? You can see that action in the charts. You can also look at options activity, John. People making bets, outsized bets relative to what you've seen over the last few months. So you can look at that stuff and you can get clues. But I agree with the premise of the question, John, which is no, I'm not going to look at a head and shoulders pattern in some $50 million biopharma play and start adding or subtracting position based upon that. And that doesn't make any sense to me.
In the biotech space, but the question was biotech versus pharma, right? And then I think in the pharma space, especially the large cap pharmas, you can, I think, recognize distributions and accumulations. And then I do think, again, these are larger cap stocks like a Merck or an AbbVie or something like that. But I do agree with you with the biotech space. I think there's just so much randomness in terms of clinic phases, or rumors, or whatever, right? I mean, here's a chart of the biotech space, and this is a weekly chart pretty much since July of 22. I mean, it's just up and down, up and down. It does not really have any kind of direction, right? And that's probably because all these different stock companies come and go, which is kind of more of your point, right?
Yeah, and I think people, John, have a tendency to group biotech together with pharma. They put /pharma. It's not the same thing. I think what people mean oftentimes is biotech and biopharma. Biopharma is being some sort of combination between pharmaceutical and biotech.
Right.
And I think this particular person was probably talking about sort of like smaller cap, micro cap type stuff, John. And if that is the case, yeah, I don't think you would look at a Head and Shoulders pattern in some micro cap biotech
No,
and stuff.
but in a big pharma, and this is kind of my point. Here's Merck,
Yeah,
right? I mean, this to me
yeah,
is an obvious level of distribution, and then this is not accumulation, but distribution. But here looks to me that looks like accumulation to me, right? I mean, so I think it was more about the biotech space, and that's what kind of threw me off on this question. So I think your point is very valid. Now, you also told me something when you were an options traders, they kind of restricted you from trading biotech stocks. Is that right?
yeah. A long time ago, you guys know I was a volatility options trader, and biotech, biopharma, all these names were completely off limits. Could not touch them. You can look at them, but you're not allowed to trade them. And the reason is they're just so unpredictable, John. You just can't. We were volatility traders. We're not biotech researchers, right? We don't have the knowledge to know what's coming down the pipe or what's going to happen. So,
all right, buddy. I hope that answers that question, because that was kind of a weird question for me. So go ahead.
all right, John. With the success of Broadcom this week and the decrease of NVIDIA and AMD, we've seen a little bit of weakness in those two names. Is that an indication to you, John, that maybe Broadcom is gaining on NVIDIA and positioning itself for the future in the minds of investors?
So I had this interesting conversation with a friend of mine. I did a show last night. My friend Trader Merlin and Trader Merlin show, and we talked about this idea of passive investing, and that what is happening is that this concentration of these large mega cap stocks, that passive investing, that every dollar that you put into, let's say, a large growth fund, a certain amount of it goes to a higher and higher concentration of the Mag 7. Now, is there a rotation from the Mag 7? Maybe, Tesla is fallen out of favor a little bit of recent, and has Broadcom, taking, its space. I think that is a fair and valid point. So let's go to, let's say, the SPY, and I'm going to look at the constituents here. And we look at the constituents in the SPY, and again, this concentration, right? NVIDIA, Microsoft, Apple, right? You're talking about almost 20%. These three, every dollar you put into the S&P, 20% of 20 cents of it goes to these three stocks. Well, here's Broadcom. It's 2.5%. About a year ago, it wasn't even near that. It was close to the top 10. It was probably in that second tier. What has happened now is Broadcom is now getting more of a lion's share of this passive investing. So what does this mean for us as investors, right? I think it means that where's the alpha for us? Well, if you're just going to buy the S&P, you might as well just buy these top 5 stocks or top 6 stocks. So I don't think it just matters what Broadcom is doing. I think Broadcom is now getting more of the allocation of the pie. So where do we could look for alpha? Well, let's start watching for stocks that are rising in this allocation game. Now, one of the stocks that that I hate, that I never really understood until recently, was Palantir. And Palantir, remember when Palantir became part of the S&P, it was getting less than 0.2% of the allocation, and now it's getting almost 0.6%. Now look at it in terms of what other companies that are below it, right? Bank of America, Chevron, GE, United Healthcare, Coca-Cola, Wells Fargo, Philip Morris. Is Palantir a better company than these companies? Is it worth more than these companies? I don't know. All I know now is that Palantir is getting a greater allocation of the pie of passive investing. And so I think this is the story of Broadcom, and that Broadcom is rising in that ranks. So I don't care what Broadcom does. I don't care what the results are, because passive investing tells me that every month money is going to go into Broadcom, and it's going to get greater and greater and greater. So that's kind of my take right now on this concentration story. I don't know if that makes sense to you.
Yep, makes a lot of sense to me, John. John, what do you think of covered call ETFs? Do you ever look at those?
They call them call rights or right ETFs. I have, and I've had in. I recommended a couple of my daughters to put a little bit of an allocation into them. They work a lot better when the market is trending, obviously, like it is now. So they do a little bit better. Um, I think it's just another strategy, right? I do use cover calls in my personal trading as a way to increase income. And then I'm sure a lot of these institutional traders that do these right calls um, are probably a little bit more in tune, you know. So yeah, I think it's a good strategy, and I haven't really looked at the ETFs, but I have recommended a small allocation to my daughters to try to take advantage of it. This is more of a consistent way to create income and also to participate in a rising market.
John, do you think BRICS are making any headway against the US dollar?
Yeah, I think that's exactly what we were just talking about. Uh, Brazil is part of BRICS, right? India, the Indian market had been on a tear of recent. I think as recently as just had a bit of a correction. Um, so it's not the emerging market, right, so to speak. I guess somewhere's quasi in between because Brazil is a well-developed economy. But I do believe that this new world order, this new world financial order, where China is starting to, be a dominant player. I think you have to respect who China buys products from and who they have a large trading relationship with. And I think in countries like Brazil, which has oil, it has natural resources, it has agricultural products. They're the largest soybean grower in the world. They're going to benefit from this new world order that is taking place, which is pushing U.S. out. Argentina is a country that had struggled for years from hyperinflation. They've gotten their act together, and Argentina now is starting to become a dominant player in South America. So I think this is just a mega trend based on global economic activity that is moving away from the dominance of the U.S.
Ralph made a comment, John, that Google just got hit with a $35 billion fine by Europe. Yeah, that sounds like a lot of money to you and me, John. But when you're worth 2.8 trillion, that sounds like a check you can go ahead and write.
Yeah, I wonder how much Google is going to spend on AI this year. 50 billion?
Probably, at least what they're going to pay Europe in the fine, right?
Yeah.
Um,
Do you want
all
that
right,
in
here's
a
a question.
check?
As Randy Moss would say, John, straight cash. Here's a good question, John. And it's about one of your favorites, Tilray. When you
Yes.
first mentioned it, they said they jumped in on it. They're sitting in a huge profit, and they want to know, are you still holding it? And
Yes.
they also okay, you're still holding it, and they also want to know what is the next stock that's going to do another 100%, John.
I'm working on it. I'm always scanning the market. But I'm working it. The problem with Tilray right now is I think you got that initial buzz feed out of it with what's going on with the potential of the rescheduling of cannabis. There's still a lot of risk to this. It got we talk about gaps and you know and this one it came right to one of our gaps, and then it went right to like an all-time high, um, a recent all-time high. So I think the story is still a good story. Is that we need the follow through. We need the government to actually do what they say we're going to do. Otherwise, we could end up going right back to where we came from. So yeah, I'm still in it. On the way up here, when we got it to like that $1.50 level, I did sell some out of the money calls. I did lighten up a little bit on my position because that one was a 3-bagger for me. So I'm still in this one because I do believe the story is a good story in terms of the long run, as long as we get that rescheduling. Where do I think the next big winner is going to be? Well, I've been kind of watching the battery space, biotechs again. One of those that have very volatile sectors, and I'm still a big fan of the natural gas space. I just don't see how we can get to where the data centers want to be without bringing along natural gas. Natural gas now represents 45% of all the electricity made in the U.S., and that story is not going away. So I think, those won't be slow grinders, but I still think that that's where I will be looking for opportunities.
All right, this is going to be the last question, and then we will have gotten to every single question today, which I'm super happy about, John. Financial stocks did not like the jobs report today. Where do you see it going from here? I'm going to assume it is referring to financial stocks. John, are you still bullish on financial stocks?
Yeah, I think if you believe in the story that the Fed is going to cut rates and that's going to, bring down the cost of capital, I think that is a good story for financials, especially the large Wall Street banks. I read an interesting story in Barron's. We talked about we were going to do the breakup of Heinz. There's been a lot of M&A this year, which is positive for financials. Lower interest rates, positive for small caps. Small caps have a lot of financials. Small regional banks are in there, so that's a positive story for them. The M&A story again for the Wall Streeters, but even when they break up a stock, that's a lot of fees for the Morgan Stanleys and the Goldman Sachs of the world. So I'm still positive to the financial sector based on the anticipation of the Fed cutting rates. Okay.
Guys, we really appreciate all you coming. If you could do John and I a huge favor, if you like the show, retweet it, share it with your friends and family, leave a comment, tell us what you like, tell us what your favorite part of the show was. John and I really appreciate the feedback. One quick announcement. I am taking a couple days of vacation end of next week, guys. So we're going to be off next week, back on September 19th.
Yeah, they won't let me fly solo without Thomas, so maybe we'll do something in the future about that. But I think it's a good time. Again, we don't really need to worry about what's going to happen in the market in terms of huge volatility until we get to the following week, right? So that would be, what is that, the September 17th, 18th, and 19th is those data points and the Fed, right?
Exactly.
All right, folks, thanks so much. Appreciate it. Like Thomas says, thank you so much for coming. Until next time, best of health, manage your risk, and the good of all trading.